Hello guys, in this video we are going to discuss how we can earn time value from options. Now before you watch this entire video, I am assuming you already know option basics, especially option moneyness concept you know very well. Now, option moneyness means you should know when option is set to be in the money, when option is set to be out the money, and when option is set to be at the money. If you know this option moneyness part very well, then only you will able to understand the concept of time value, how we can earn time value from options. So let's start. Now, this is the very first slide in front of you, option buyer versus option sellers. I'm sure that you already know this. If you know option basics very well, you already know this. See, as an option buyer, we need to pay premium to enter in the contract. Maximum loss is premium paid and maximum profit is unlimited. Completely opposite for option seller. As the option seller, we will receive premium. So maximum profit is premium received or premium earned, and maximum loss is unlimited. Now you can see here, as the option seller, there is very high risk involved. As the option buyer, risk is very limited. Maximum loss is premium paid. But as an option seller, you can see we have a very high risk as maximum loss is unlimited. Now, in spite of this, guys, have you ever wondered why traders still prefer options? In spite of high risk involved in selling option, in spite of this, why some traders prefer to sell options? Answer is options are depreciating assets. Yes, options are depreciating asset. This means the price of options depreciates over time. Specifically, the time value depreciates. Now let's understand this concept of the whole premium in detail. See, the premium has two components. As you know, to buy call option or to buy put option, as a buyer we need to pay premium. That premium has two components. One is intrinsic value, one is time value. So intrinsic value plus time value is equals to option premium. Now let's understand what exactly intrinsic value is, what exactly time value is, and how we can calculate intrinsic value and time value. Now to explain this concept, I have taken one very simple example. Let's say the stock name is ABC Limited and underlying price is 1020. Now what is this underlying price? Underlying price is nothing but you can say spot price or current market price. This ABC Limited today is trading at 1020. And as a buyer, let's understand now this concept from option buyer point of view, from call buyer point of view. As a call buyer, I'm selecting strike price 1000. I'm buying strike price 1000. See, this ABC Limited stock right now trading at 1020, but I am selecting strike price 1000. Now how we should interpret, how we can interpret this strike 1000? As a call buyer, if I am selecting this strike 1000, this means my view is I am expecting on expiry day ABC Limited will close above 1000, and premium to be paid is 35. Now we need to decide how much is the intrinsic value, how much is the time value. So this 35 is the premium. So out of this 35, how much is the intrinsic value, how much is the time value? Now the very first step is, guys, you need to identify whether this option is in the money, out the money, or at the money. This call option is ITM, OTM, or ATM. This is what you need to decide. Very first thing. In this case, I can say this call option is in the money. Why call option is in the money? Because spot price is greater than strike price. Spot price is 1020, strike price is 1000. Whenever you see spot is more than strike, this means call option is in the money. Now here I can say this call option is in the money by 20 points. See, as a call buyer, I am expecting this stock will close above 1000. That's why I bought this strike price 1000. Now forget expiry. Forget expiry. Today itself, guys, you can see ABC stock is well above 1000. How many points it is above from 1000? It is above 20 points. So therefore I can say from this 35, 20 is intrinsic value, and remaining 15 is nothing but we can say it is time value. Out of this 35, 20 is intrinsic value. So intrinsic value is a value by which option is in the money. In this example, the intrinsic value is 20. So I can say this option is in the money by 20 points. So please remember guys, intrinsic value is the value by which option is in the money. So out of 35, if 20 is intrinsic value, remaining 15 will be the time value. Now why we are paying time value? Let's assume we bought this contract today. Let's say today is 10th December 2020. We bought this contract today. Now I can carry this contract till expiry. Now when is the expiry? Guys, expiry is on 31st December 2020. This December series will expire on 31st December 2020. So from 10th December till 31st December 2020, we have 15 trading sessions left. See, exchange is giving me a time to carry this contract for next 15 trading session. So for that, I have to pay some cost. So that is called as time value. Just a minute, guys. Okay, let's continue now. So I was saying that we are paying this time value because we have 15 trading sessions left in expiry. See, more number of trading sessions left in expiry, more will be the time value. If you purchase this same contract in last week of expiry, so the time value will be less. See, right now we are paying time value as 15 points. Out of this 35, 20 is intrinsic value, 15 is time value. So I am paying now 15 rupees as a time value. If I purchase this same contract in last week of expiry, so time value will not be 15 points. Definitely, I can say time value will be less than 15 points because I'm buying this option in the last week of expiry. And finally, guys, on the day of expiry at 3:30, time value will be 0. This time value keeps on falling as expiry comes near. This time value keeps on reducing, and finally on the day of expiry at 3:30 p.m. because market closed at 3:30 p.m. So finally on the day of expiry at 3:30 p.m. time value will be 0. Okay, so this call option we bought on 10th December, as I told you. Expiry date is 31st December. So number of trading session left 15. Intrinsic value is 20. How we calculated this intrinsic value? Spot minus strike. So you need to remember this formula. Spot minus strike will give you intrinsic value for call option, and time value is 15. How we calculated time value? Premium minus intrinsic value will give you time value. Now you need to understand option value on expiry. Now this slide is very, very important. See, on the day of expiry, the option value is maximum 0 or intrinsic value. Now this S minus X is nothing but you can say this is intrinsic value. On the day of expiry, the value of option is 0 or spot minus strike price. Okay, this S stands for spot price, X stands for strike price. Now this strike price is also known as exercise price. If option is in the money on the day of expiry, if option is in the money, the value will be S minus X. The value of option contract will be its intrinsic value. If option is in the money on the day of expiry, the option value will be intrinsic value. And how we can calculate intrinsic value? Spot price minus strike price. If option is out the money, or at the money on the day of expiry, then the value will be 0. Okay, value will be 0 if option is out the money or at the money. So here you can see if option is out the money or at the money, value will be 0. If option is in the money, the value will be spot minus strike price. That means intrinsic value. So let's now calculate the value of option on expiry day. So this is the same example which we discussed. So on 10th December, we entered in the option contract of ABC Limited. Strike price was 1000 and spot price was 1020 on 10th December. Premium was 35 and let's say lot size is 500 quantity. Now this is the scenario on expiry day. See, on expiry day, that is on 31st December 2020, you can see the ABC Limited price, underlying price, the price of ABC Limited on expiry day was 1020. See, when we entered in the contract at that time, price was 1020. Even on the day of expiry, you can say price is still same 1020. So in next 15 days, nothing has happened. The stock was at same price. Now we need to calculate what will be the premium, what will be the value of this option contract on expiry day. So as we discussed that on expiry date, the option value is maximum 0 or intrinsic value. So you can clearly see this option is still in the money on the day of expiry. This option is in the money on the day of expiry, 20 points, right? So the option premium will be 20 points. See, when we entered in this contract, you can see the premium was 35. On the day of expiry, premium will not be 35 anymore. Premium will be 20. So from 35, you can see the premium became 20. Premium reduced by 15 points. Why premium reduced by 15 points? Because of time decay, because of passage of time. So you need to understand the option seller can benefit from passage of time. So this time value decay is nothing but you can say it is the profit for seller. Time value decay means the option premium will reduce due to the passage of time. So when we entered in this contract as a buyer, you can see premium was 35. On the day of expiry, you can see the premium is 20. So as an option buyer, I made a loss of 15 points due to passage of time. If I have sold this option, I would have gained 15 points. I would have made profit. I would have made gain of 15 points as the option seller due to passage of time. Lot size is 500, you can see. So 500 into 15. Now, if you perform this calculation 500 into 15, you will get answer as 7,500. As the option seller, I made 7,500 on expiry day. So option seller can benefit from passage of time and time value decays profit for seller. Even if underlying asset is stationary. You can see when we entered in this contract, underlying value was 1020. On the day of expiry also, you can see still underlying value is 1020. There is no change in underlying value. Therefore, premium will reduce. Premium will not increase. In fact, premium will reduce because of the passage of time. So as an option seller, I am interested in earning time value. Now, so the same concept, guys, apply in intraday. There are some days when you see a bank nifty is completely flat. Nifty is completely flat. Nothing major is happening in the market. Let me show you. So this was 27th November. This is bank nifty price graph, 15 minutes time frame. This is 27th November trading session. You can clearly see bank nifty is completely flat throughout the day. This means the underlying is stationary. Nothing major is happening in bank nifty. So this is the very first candle and this is the last candle. You can see bank nifty is completely flat. So what will happen on this day? Premium will reduce. Call option, put option, both options premium will definitely reduce. So if we buy option on day like this, definitely we are not going to make profit as an option buyer. As the option seller, we can make profit on this day by selling option. Why we will sell option? Because we know because of passage of time, premium will reduce. If premium is about to reduce, I will be happy to sell option instead of buying option. So option sellers completely love day like this. They want day like this when underlying is completely flat, premium will reduce. So that premium will be the profit for option sellers. So we are going to learn in this session how we can design one such setup which will give us good profit, which will give us decent profit in intraday from 9:15 till 3:30. Now one more example in front of you, again bank nifty. Again on 4th November you can see nothing major happened. The day started with this candle, the day ended with this candle. So you can see the bank nifty is completely flat. So whenever you see bank nifty is not moving much, it is completely flat. So call option, put option, both options will lose value, both option will lose value because of time decay. Now let's understand one more example. Okay, this is now example 2. On 10th December, ABC Limited was trading, let's say now at 980. So this is the next example. Now in this example, I have assumed the ABC Limited current market price is 980. And again, we are buying, let's say call option with strike price 1000. Premium is 15. Now again we need to identify out of this 15 how much is the intrinsic value, how much is the time value. So again the very first step guys, you need to find out whether this option is ITM, OTM or ATM. Now in this case I can say this option is out the money because spot price is less than strike price. So whenever you see spot is less than strike, this means call option is out the money. Now if call option is out the money, intrinsic value will be zero. Intrinsic value exists only for in the money option. If option is OTM, ATM, intrinsic value will be zero. Why? Because the definition of intrinsic value is the value by which option is in the money. If option is not in the money, so simply intrinsic value will be zero. So out of this 15, intrinsic value is zero. So I can say this entire 15 rupees is time value. See, if option is out the money, entire premium component will be time value as intrinsic value is zero. Now let's see what happened on the day of expiry. On 31st December, that means after 15 trading session, this ABC Limited was trading at 990. On the day of expiry, the price of ABC Limited, the spot price of ABC Limited, let's say closed at 990. Now we need to calculate how much is the premium on the day of expiry, how much is the value of this contract on the day of expiry. Again, you can see guys, on the day of expiry, this option is still out the money. Spot 990 is less than strike 1000. So this option is out the money on the day of expiry. So going with this logic, on expiry day, the value of option is maximum zero or intrinsic value. I can say the value of this option is zero because this option is out the money. Value of any option, be it call option or put option, value of any option on expiry day will be either zero or intrinsic value. Zero will be when? Zero will be when option is OTM or ATM. If option is in the money, the value will be intrinsic value. So this case is of out the money. On expiry day, you can see this option is out the money. Therefore, I can say the value of this option contract will be zero on expiry day. See, on 10th December, the value was 15. On 31st December, you can see the value is 0. So I can say premium reduced by 15 points. So again, as an option buyer, I am losing 15 points because of passage of time. As the option seller, I am making profit of 15 points because of passage of time. So you need to understand option sellers are only interested in time value. Now this is the third example. On 10th December, let's say ABC Limited was trading at 1000 and we purchased call option with strike price 1000. So this is the case of at the money now. Spot price and strike price, you can see both are same. When spot is equal to strike, option is set to be at the money and premium was, let's say, 20. Now again we need to find out of this 20 how much is the intrinsic value, how much is the time value. So as option is out the money, sorry, as option is at the money, again intrinsic value will be 0. So you need to remember intrinsic value exists only for in the money option, because the definition of intrinsic value is a value by which option is in the money. If option is not in the money, intrinsic value will be 0. So out of this 20, intrinsic value is 0. So again, this entire 20 is time value. So you need to remember this point for out the money option, at the money option. Entire premium value component is time value. Now let's see what happened on day of expiry. On day of expiry, again you can see ABC Limited strike is ABC Limited spot price is still 1000. On 10th December, when we entered in this contract, price was 1000. On expiry day also you can see price is still 1000. So now what will be the new option value? So going by same logic, on the day of expiry, any option value will be max of 0 or intrinsic value. Now this 0 will be when option is OTM or ATM. So you can see this option is ATM on expiry day. So again I can say the option value will be 0. When we entered in this contract, value was 20. On the day of expiry, what will be the value? Value will be 0. Premium will again reduce by 20 points because of passage of time. Okay, now let's take one last example. So let's say on 10th December, ABC Limited strike price was 1000, spot price was also 1000, premium was 20. On 31st December, ABC Limited spot price was 1060. Now you can see this option is in the money on expiry day. So now the value will be 60, not 0. On expiry day, the option value will be max of 0 or intrinsic value. This 0 will be the value when option is out the money or at the money. Intrinsic value will come in picture if option is in the money on expiry day. So you can clearly see this scenario is of in the money. Spot 1060 is greater than strike 1000. So this option value on the day of expiry will be 60 points. So as an option buyer, I will make profit of 40 points, but as an option seller, I will make a loss of 40 points. Okay, now let's guys understand how we can take advantage of situation if I already know that option premium will reduce. So as an option seller, how I can take advantage of this situation. So let's say if I'm expecting today bank nifty will be completely flat in intraday. So what I can do to earn time value? So if you are expecting that bank nifty will be flat, what you can do, you can design short straddle or short strangle strategy. Okay, now you need to understand when to design this strategy. Then you need to understand how to design this strategy, what will be the maximum profit from this strategy, and what can be the maximum loss from this strategy. So these 4 points are very, very important. When to design this strategy, how to design this strategy, maximum profit and maximum loss. Let's first discuss when to design. See, when you expect that there won't be any major move in underlying asset, we can design this short straddle or short straddle strategy. So you can see this graph again. On this day, what happened to Bank Nifty? Bank Nifty was completely flat. So on day like this, we can design short straddle or short straddle strategy. So we can design this strategy. We can design this strategy when we expect that index will move sideways. So either Nifty or Bank Nifty, if you expect index will move sideways, you can design this strategy. Now, how to design this strategy? We can design this strategy by selling call option and put option with same strike price. See, if we are keeping same strike price for both call and put option, then it will be termed as short straddle strategy. If I am selecting different strikes, call option with different strike price, put option with different strike price, then we will use the term strangle instead of straddle. So if we are keeping same strike price both for both call and put option, the name of setup will be short straddle. If we are keeping different strike prices for both call and put, the name of setup will be short straddle. Okay, now again I will focus on when to design. So as of now, I just told you we can design this strategy when we expect index will move sideways. Now when I will take live session, at that time I will explain you in depth when to expect index will move sideways, how we come to know in advance that there is very high probability that index is likely to move sideways. So that part I will cover in my live session. The objective of this in video is to make you understand, as an option seller, we can earn time value. How we can earn time value? We can earn time value by designing short straddle or short strangle strategy. So when to design, I'm going to cover in depth when I will take live session. So we use CPR. We also check. So let's say if I'm designing this strategy on expiry day, so I will also check what was the closing price of previous day, that is on Wednesday, because weekly expiry is on Thursday. So I also need to check closing price of Wednesday. I also need to check opening price of Thursday on expiry day, at what price index open. We also look CPR to select right strike prices. Selection of strike price is also very important when you want to earn time value. So all these things I'm going to cover in depth when I will take live session. So as of now, you just remember we can design short straddle or short strangle strategy when we expect index will move sideways. How to design? Just sell both call option and put option with same strike or with different strike. Now this setup is intraday setup. We are not going to hold till expiry. We are not going to carry forward this call and put option till expiry. This is a pure intraday setup. So guys, what we'll do when we are getting 10% profit, when we are getting 10 percentage of combined premium received, I will close this trade. Now let me explain you what is the meaning of combined premium. See, as I told you, in order to design this strategy you need to sell call option and put option. Now let's assume now bank nifty, okay, call strike is 30,000, trading at, let's say, 400 rupees. Bank nifty put option is bank nifty put option strike, bank nifty put option strike 30,000, trading at, let's say, 450 for example. So you can clearly see I'm designing short straddle because the strike price for call and put is same, 30,000 30,000. As a seller, if I'm selling call option strike price 30,000, I will receive this 400 rupees. As a seller, if I'm selling put option strike price 30,000 at 450, again I will receive this 450 rupees. So the total premium, okay, total premium received is rupees 850. 400 from call, 450 from put. So total premium received is 850. Now this rupees 850 is called combined premium. So as a seller, when you sell both call option and put option, you will receive 850 rupees. Now why we are selling this both call and put? Because I am expecting bank nifty will move sideways. If bank nifty will move sideways, what will happen? Due to passage of time, option premium will reduce. So as a seller, I will make profit. So therefore, I am selling both call option and put option. Now, what will be the 10 percentage of 850? As I discussed, maximum profit will be 10 percentage of combined premium. So 10 percentage of 850 will be how much, guys? 85 points. Lot size for bank nifty is how much? 25. So now when you do this calculation, 85 into 25, okay, that will be your maximum profit. And believe me, this much profit is definitely possible when you design this setup in intraday. So you can easily make 80 85 points on the day when bank nifty is not going anywhere, when bank nifty is completely flat. So 85 into 25, that will be your maximum profit. So when you are getting 10% of combined premium received, you can close this trade. Okay, buy call option, buy put option, and close this trade. Book profit. Now let's see what will be the maximum loss from this strategy. Again, maximum loss will be 10 percentage of combined premium received. So either you will make 10 percentage of combined premium or you will lose 10 percentage of combined premium. So the combined premium in this example, we received 85, sorry, 850. 10 percentage will be 85. If you are making a loss of 85 points from this strategy, you can close this trade. Now let me share, backtesting result. See, in the month, in the year 2020, from February 2020 till November 2020, we got total 40 trades. In year 2020, from Feb 2020 to November 2020. As per this setup, guys, we got total 40 trades. Now, out of these total 40 trades, 8 times our stop loss was hit. So 8 times we made loss because combined premium went up by 10%. So when combined premium will go up by 10%, we will close this trade. And 32 times we made profit. So if I share, profit figure with you, the total profit from this setup was rupees 43,500. So one of the best setup you are going to learn if you join with me in live session. I will share total 2 setups with you. One setup will be for only expiry day, how you can earn time value on expiry day. And one setup I will discuss for other days. Friday, Monday, Tuesday, Wednesday, any day you can get, opportunity. So one setup will be for expiry day. You can design that setup only on expiry day, that is only on weekly expiry. Second setup will be for other days. So I hope guys the concept of time value is clear to you. I'm looking forward to join my live session where we can discuss in depth how we can design this strategy. So as I told you, we use CPR, we use Wednesday closing, Thursday opening, and then we select right strike price to earn time value. Okay, that's it in this video. Thank you very much for your time.